Hey YouTube, this is Zach with Achilles Financial, and today we're going to be talking about a series of economic data that's going to be coming out this week. I am filming this video today on Sunday, July 22nd, and we're going to be covering not only this week's economic indicators, but I also want to dive into the data that came out this past Friday, in particular associated with the unemployment rate. However, there's also some additional data here available for us to look at. The first thing that I want to talk about is when we talk about payrolls, the consensus estimate was the $250,000 of jobs that were added, and actually what came out was 390,000 jobs. So while this was viewed as a really good jobs report, I would call out that what a lot of investors are looking for is for any reason why the Federal Reserve would slow down in terms of their rising interest rate environment. So what we need to look at is this actually a good thing for long-term investors? Right at this point in time, I'm continuing to encourage a lot of what I'm doing is staying fairly cash heavy, selling covered calls on those big updates, and then slowly buying certain stocks on an ongoing basis, but overall maintaining a very heavy percentage of the portfolio in cash. So let's talk about the unemployment rate and why that may be good, and I'm going to head over to Fred to be able to do that. And here I am on the Fed Reserve website. This is going to be the Federal Reserve Bank of St. Louis. I've got the unemployment rate here on the screen. This is going to be a simple math equation with the numerator being the percentage of people who are looking for work and unable to find it, and the denominator being the people who are actually working. So we have a very, very comfortable level of unemployment rate right here. But it's important to note that despite the fact that we are back at pre-COVID levels, there is a concern in the fact that we have the labor force participation rate. So if you were to go to the Fred database and look at this labor force participation rate that you can see here, you can see that we are still at levels not seen since the 1970s in terms of the percentage of the U.S. population that is actively working right now as a total percentage. Now, some of that is due to retirement ages, some of which is people leaving the workforce, but you can see that we have significantly less people working right now than there were previously during pre-pandemic time, so from 2019 into the early part of 2020. This is a trend that's continued since the recession and the great financial crisis. And again, that reason is again partially due to labor demographics and retirement age, but also due to the fact that not all the jobs from pre-COVID have come back. The reason why this particular metric is important is because we just saw from May to June the labor force actually shrank, which means that we're going to continue to see upward pressure in terms of people who want jobs are generally speaking going to have multiple opportunities, which is keeping wages high, which is keeping inflation high, which means that the Federal Reserve, whose dual mandate is full employment and high or low inflation, they're going to continue to feel pressure there. So the question is, how is this impacting? Why are we, or where are we seeing some pain points in the overall market? And that's a good question. And we're going to go over to the Bureau of Economic Analysis for that answer. So what I have here on the screen is the Bureau of Labor Statistics for the United States. And what I'm going to be pointing out is we have the average weekly hours and overtime of all employees. And I would call out that you can see that for those total private, that is actually increasing from what we saw in both April, May, and June. Now, part of this is we are continuing to see people take on not just one, but two jobs across the United States. Now, what this is doing is people are working more, but we're earning less. And I'm going to take you to a different metric for that. And now, again, on the same website, you can see up here for the records or for what times people are working, is you can see that we just saw that people are working more, but the average hourly rate has dropped more than $1 from $31.86 to $30.52. So how in the world are people working more but earning less? Well, at this point in time in an economic cycle, what you're going to begin seeing companies do is start to drop the dollar amount or the number of people that are working in salaried roles and start to bring on people in hourly roles because it's generally going to be more cost effective for them to be able to do so. Now, what you're seeing is the fact that we have less people working at a lower rate, but they're working more hours, and we're seeing that get dragged across the board. So some of the pain points that we can expect to see is if this continues, that means people are earning less, the cost of goods are going up due to inflation, and you're going to continue to see that hit workers where it hurts. So how does all that information affect us here today? Well, we've got a number of different items that are going to be coming out this week. with the chief information going to be coming out this Wednesday, July 13th, where we've got that CPI data. Now, that's going to be coming out at 8:30 a.m. Eastern time, but you can also see that we're going to have the mortgage applications data come out prior to that. And again, one of the big areas associated with inflation is going to be tied out to the housing market. We have seen home prices slow, but they are still at record highs. And we're looking at year-over-year metrics, at which point in time I continue to expect to see that we're going to see some pain in that metric associated with the housing market. We're also going to see that CPI data point, which again, if that continues to be very, very high, the Federal Reserve is going to continue to aggressively raise interest rates. We're also going to see crude oil inventories, which is one of the key drivers of inflation, is going to be those gas prices and those oil prices, which we've continued to stay at elevated levels, although gas prices have declined slightly over the course of the past 2 weeks. Now, with Thursday and Friday, we are going to see additional jobless claims and that producer price index, which is going to be the inflation data for producers versus consumers, and expect that to come out on Thursday before we get a slew of data on Friday that's going to be primarily associated with the economic metrics in terms of how well is the consumer. So you're going to see retail sales, which we're going to see, hey, are people still spending money? You're going to additionally see inventory data, which the idea here is that inventories are building. If those inventories are building, that means we should see cost cutting in the future, but we have not seen that at this point in time. So there's a ton of data coming out this week that's going to be super important for the market, for the economy. However, that's all going to be somewhat held up, and as individuals await the FOMC, the Federal Open Market Committee's decision on, are we going to see higher interest rates? What is their forecast going forward in terms of where do they expect interest rates to go? This is also going to be the same time where we start to see earnings ramp up based off Q2. So we've got a ton of earnings that begin this week and go into the next few weeks. So there's a lot of moving parts right now, but the point of this video is going to be the focus on the economic data that we're going to be seeing this week, as well as what came out this past week. So we'll continue to monitor this. We'll talk about this in the Discord in the description down below, which is free to join. And if you find this content helpful, please leave a like and subscribe. Thanks. Talk to you later.